Thank you. Mr. Matty, you're a community banker, and you kind of have a unique view of too big to fail because probably 1 out of every 1,000 businesses is deemed too small to save when you have too big to fail. How does that strike you as a banker of a smaller institution? Do you think there's any fairness in the too big to fail doctrine?
As a small banker, and I speak for myself here, of course, not the industry, I do think that we should have limits in place that keep institutions from being so large that they create risks that endanger our entire economy. I don't think that that's sound policy, and I think that it should be dealt with. And I think that we can do that. We can keep these institutions from being so large, and then we can allow them to invest in some of these private equity situations. And then if they do go under, then the whole process works because it's true capitalism. And that's my opinion.
I think that it would be true capitalism. If you're too big to fail, you're too big to exist.
Right.
I think actually Mr. Volker and many of us in Congress say if that's our only choices, is we either bail them out or or if they will bring down the economy if we don't bail them out, then they're just too big. Because to me, although the new report by the overseer of the TARP has said that Dodd-Frank actually institutionalizes too big to fail. So you have these institutions that are just, you can't let me fail. I'm too big. I'll bring down the economy. So I think our choices are we going to bail them out, or are we not going to allow them to exist in that form? I have a conversation. I heard your testimony and had read part of it, and it's the same conversation I have with small banks and even regional banks all over the country. And that they also, before Dodd-Frank, even before that, they were micromanaging your loans and second-guessing your loan decisions. Do you believe that you're best able to make decisions on who to loan money to and under what terms, or that a bank examiner or a regulator in Washington is best able to?
Yeah, clearly I think that the community bankers are in the best position to make those decisions. And I would even go a step further, though, and point out, at least in my own experience, the examiners that have come on site, the people that know the area and who have worked in those areas for years, actually have been pretty reasonable throughout this entire process. Right. Most of the stringent and overzealous actions have come from somewhere above. We don't know exactly where, but it's certainly somewhere outside of their hands. And in candid conversations, they will, to the degree that they feel comfortable, even admit that in some cases they don't really agree with this, but this is just how it is.
Yeah, I heard Paul Ryan use the same term I used last week when I was appearing before the FDA. I was on a panel with Sheila Bair and Ben Bernanke. And that's American exceptionalism. And we in America, I mean, our whole country was founded on the premise that we're all have the freedom to succeed or fail. And we don't look to the government to direct that, or to pick winners or losers, or to be there as a safety valve for a too big to fail company. That really, the people are entrusted with the ability to make choices, and then they should live with those choices. Now, if you're talking about the FDIC and insurance, deposit insurance, obviously, if your underwriting standards as a whole bring risk to that, that's one thing. Right. But this idea, and I've talked to a community banker in Alabama who regulator examiner, and he was new, been on the job about a year, looked at an $8,000 car loan to an 82-year-old woman whose son owned the biggest business in the county, and said the car's not worth $8,000, and made him write it down to $6,000. Even though the loan was current, she owned her own house, and as the banker, and this is relationship banking,
Right.
and I think that examiners and regulators ought to appreciate those relationships, and they should not violate those relationships. And when he said, this family, you know, I've dealt with this lady for 30 years. Her son is a customer of the bank. He's good for it. An examiner ought to trust the business. They ought to trust that you're in business to make a profit, not to go broke. But I think what they're doing, I hear this, that they were too lax in the good times, and you mentioned something, and now they want to kind of make it up.
Right.
And, you know, the time to be tough, and I think that your testimony is before, when you're doing something wrong before an economic turndown. And I think that's going to be one of our challenges. But I'm not sure that we can all of a sudden start. You can't have capitalism without capital. And whether you reserve it under Dodd-Frank to telling end users or derivatives, none of which there's still hadn't seen a case where it caused any harm to our financial system or to those industries by end users like a Southwest Airlines or a John Deere hedging gasoline or fuel or currency. We've never seen an incident where they did anything that caused the financial system any concern, or even that wasn't profitable for them. Yet under this new bill, they've got a reserve capital for that could be going into job creation. I will say there's a bipartisan consensus building that we need to change that. And I have said before, there are good things about Dodd-Frank. There are bad things and there are ugly things, and that's one of the ugly ones.
With the